Astera Labs, the company, is on fire.
It sure is.
Great report in the most recent quarter, but the stock is not so much. Actually, over the last 6 months, it's traded sideways or even down. And why is that? We want to talk about why that is. But before we do, quick shout out to the sponsor of today's video, Fiscal.ai, who we use every single day here at Chipstock Investor.
Take a look at this chart. We will discuss this more in depth later in the presentation. This is a great feature here. You aren't just seeing a chart of Astera Labs quarterly financials over the last couple of years. You actually can pull in Wall Street analyst estimates as well, which is really handy when you can compare that with management's actual guidance when stated, like Astera did in their Q4 2025 report. Their guide for Q1 of 2026 absolutely crushed estimates. So, fantastic tool that we use here when using Fiscal.ai. Make sure you check it out.
And you can get 15% off any paid plan with our unique link, fiscal.ai/CSI. Fiscal's done some aggressive price decreases. Even their Pro plan has come down in price. So check it out. You can get an extra 15% off. Now, Credo has not reported earnings yet. They just finished up their quarter in January. We'll be awaiting those results here in a few weeks. But let's look at these key points. For both of these companies, really fast growth persists. How high can profitability fly? And let's take a note of their customer reliance and concentration, especially for Astera. We'll get to that towards the end of the video. Astera Labs fits into fabless chip designers. They also have IP, and they focus primarily in clocking and timing, retimers, and we'll show you some of their other products as well. Tons of competition in the networking space from some of the biggest names in the business, of course, Broadcom. Marvell is also in this as well, ADI, Microchip, AMD, TI. And if you break that down even further, in the transceiver manufacture and design, there's even more players in this. Astera is working on expanding their products beyond just those retimers.
By way of reminder, think of a retimer like that relay race handoff analogy we've referred to a couple of times in the last couple of years. When these cables get long in connecting different parts of the data center, you need a retimer in there to refresh the signal. And so it works with a lot of other parts and pieces. And right there, you learn a lot of qualitative things about Astera Labs and Credo technology. One of our big questions around these two businesses, which we have ownership in as well, is they're a supplier to a limited number of customers. There's lots of other suppliers that they compete with. So they're not dominant players in a niche market necessarily, and they don't have a ton of breadth and depth to their operation. So these are going to be things that they need to change over time if they're going to remain great compound growth machines for the long term. Otherwise, it may just be like a multi-year swing trade for companies like Astera Labs and Credo. There's some of the products. Hopefully that helps with some of the qualitative stuff. So they're expanding the breadth of their portfolio. Here's another way that they were doing this: more acquisitions to consolidate market share. Unfortunately, there's risk with that, but this is the necessary type of thing that they need to do.
Yep, here's the acquisition announcement of AI X-Scale Photonics, expertise in optical I/O precision glass coupler technology.
This is kind of like Marvell purchasing Celestial AI, more optical IP getting acquired.
Okay, let's look at the numbers. This is on total revenues on a quarterly basis. In December, ended at 271 million. Wall Street expectation was around 260 million for the upcoming quarter, but actually the guidance from management, 292 million, which is up 84% year over year.
Definitely growing faster than the market. Next item on the checklist: what about profitability? Are operating margins expanding? Overall, yes. You can see we have free cash flow and net income charted here. We'll just use that as a proxy for operating leverage for the time being. Overall, over the last 2 years, they are scaling up their profitability. It's a young company, though. These metrics are going to be volatile, especially free cash flow. We had mentioned this A couple quarters ago, that massive 133 million free cash flow was a one-time event. It wasn't going to repeat. Sure enough, we're back to a more normalized level. And couple of things to take note of here in the Q4 report. There were some higher expenses realized in this latest quarter, which you can expect from a young and fast company like this one.
Yeah, more R&D spending as well as SG&A expense, stock-based comp expense as well.
Overall,
Yeah.
we can check this box off. There's good profitability expansion taking place.
Let's compare that to Credo.
Okay. The far right is the Wall Street expectation for their next quarter, which is Q3 of fiscal year 2026 for Credo. That quarter, as Casey just mentioned, just completed a couple weeks ago at the end of January. So we have a few weeks to go before we get this report. But you can see how fast this one has also scaled up. This company is a bit more niche. Originally, their big banner product that everybody was talking about were those purple cables used in data centers with active electrical cable AECs. They have also begun to expand even active electrical cables. They're not the only ones that design IP and chips for those. Astera also does it, as do a lot of others. But you can see the faster pace of growth we will attribute to Credo having a bit more narrow focus on one product, and also a little bit more linear scale up of the profitability as well. That may not be exactly related to the more sharp focus on one product, but at any rate, both boxes are still checked for Credo as well. Now, moving on though, and this is where the numbers that you would want to check off in your thesis also need to match up with the qualitative part of the business, and it needs to be monitored to make sure that those financial numbers continue to line up with the qualitative reasons you invest in the company as well. And this is where understanding the supply chain and competitors comes into play. We already talked about the long list of competitors, but let's go back to Astera here and talk about customer concentration risk. This is a big one. This is important.
Right. In the very far right hand side of the flowchart, enterprise consumer software, the hyperscaler customers are where Astera is concentrated. Alphabet, Amazon, Meta, Microsoft, Oracle, those are their biggest customers, and they're highly reliant on CapEx spending from them.
And they do mention some of their other customers. Instead of selling directly to the hyperscalers, sometimes the customers are system designers and other chip companies like AMD, NVIDIA, Broadcom. But ultimately, the end customer is still the same. The end customer is still one of the data center companies, one of the hyperscalers. So it doesn't matter who they sell to exactly in the supply chain. The end customer is still highly concentrated. This was announced along with the quarterly earnings, and this is notable.
This is where we want to keep a closer eye on these companies, because this makes us wonder about their long-term viability as an investment for the long haul. Astera Labs gave Amazon more warrants contingent upon the purchase of up to $6.5 billion in Astera Labs products. So basically, this is Amazon purchasing their products at a discounted rate at the expense of Astera shareholders.
Unfortunately, yeah, that's pretty much the only way you can look at this one. Interestingly, Amazon had an almost identical type of an announcement with a different chip supplier, ST Microelectronics, that we pointed out the other day. This is the same type of deal that AMD struck with OpenAI last year. This is not a huge dilution event. So you can see it was almost 3.3 million shares in the warrants that will vest in tranches over the next 7 years or so. 3.3 million shares over the next 7 years is not that big of a deal. Total shares outstanding, almost 169 million. So we're looking at just under 2% dilution at today's share count. But it's not really the dilution that's the issue that we're calling out. It's that Astera made the sale with Amazon contingent on gifting Amazon those warrants in the first place. It's a customer discount, and that's just not indicative of a company that is dominating a technological niche. Because if you dominate a niche, you can command pretty much any price that you want and tell your customer, take it or leave it. And it's certainly not great control over the supply chain either. So some items that you would want to keep track of, because when you start to see issues show up in the financials, you want to go back and retest the original thesis that you had qualitatively. So Astera, great technology. They're in the right place at the right time with AI data centers, but is that good enough to have a set it and forget it type of investment thesis on this one? And I think the answer for us, as we've explained before, and we're reiterating now for Credo, or for those of you that own Astera or both, these are not, in our opinion, unfortunately, at this point in time, set it and forget it businesses. A lot of things need to develop over the coming years for them to prove that status.
To round out the discussion, let's do a reverse DCF.
Hopefully you woke up with a cup of coffee and like, yeah, reverse DCF with Nick and coffee.
Yeah.
I think this should be your thing, actually. Like morning coffee with Casey.
Yeah. So currently the price for Astera is around $144. And we used a blend of earnings per share and free cash flow per share. They're not too far from each other, so it doesn't change too much. With the weighting, growth rate at 42% over the next 5 years, terminal rate of 6% gets us to about $144 per share.
Interesting. Even with an almost 20% haircut on the stock price, the bar is still obviously set very high. A per share profit growth of 42% over the course of 5 years. Obviously, you have to expect not only the AI data center build out to continue at a very fast pace, also that basically factors for no cyclical slowdown or downturn over the next 5 years either. So I guess I'm not surprised the stock is coming down quite a bit. Well, we're going to continue watching these two closely. Credo, we saw kind of dipped all the way to under 100 last week. Not surprising, but this is where these companies are at. They're suppliers with a limited number of customers, so they need a little bit more babysitting than average.
If you want an overview of AI data center networking, optical, and silicon photonics, make sure you check out this video right here, Top AI Chip Stocks of 2026.